Thanks, Richard, and hello, everyone. As Richard says, I'm head of the UK Mid and Small Cap team, so we're managing about $4.5 billion in the UK mid and small cap space. I'm on slightly unfamiliar ground today because the eagle-eyed amongst you may have spotted that I think when this event was originally being planned, Richard Watts, my colleague and manager of the UK Mid-Cap Fund, was due to be talking. I'm afraid he's had to go to a funeral, so I'm stepping in, but I am going to talk about mid-caps rather than small caps primarily. So the format of what I'm planning to talk to really is in three parts today. The title, plotting a course through a post-Brexit vote, is really intended to aim at the idea that we acknowledge that we face slightly unique challenges given events. However, I think there's a lot of data that we can look back to help us assess the relative attractiveness of mid-caps at this point in time. So we'll be working through that over the next half hour or so. Outside of that, really sort of three key areas to look at. So firstly, what are the key considerations? What sort of issues are we thinking about as a team to help us decide how to position the funds at this point in time? Secondly, taking a step right back, what is the longer term case for investing in the UK mid-cap space? And then finally, how are we actually positioning our funds at both a thematic and a stock level at this point in time, and why? So, sort of starting there in terms of the key considerations, using the word Brexit as a sort of bullet point doesn't really do it justice. I could be standing here all day talking about it. But I think the observations that we would make, firstly, simplistically at least, the data that we've been seeing from the UK economy is nowhere near as bad. In fact, it suggests relative stasis in terms of the progress of the UK economy post-Brexit versus pre. So certainly that has been a surprise. If we try and assess where we think we are, and there have been relatively few data points clearly, if we look, for example, at the PMIs that we've seen both manufacturing and services, after that big drawdown in August, a big bounce back in September, suggesting, we think, over the course of Q3, that we'll see something like 0.2%, 0.3% GDP growth in the UK. So something of a slowdown perhaps following the 0.7 that we saw in Q2, but again, by no means as severe, I think, as perhaps some of the more bearish commentators would have been suggesting at the point of the referendum itself. And as we look out to 2017, I think our best guess, or our working assumption at least, would be that we expect something like 0 to 1% GDP growth for the UK. So again, you'd characterise that perhaps as a slowdown, but not the meltdown, again, that I think some commentators would have been looking for. And I think, clearly in very recent days, or more recent days, since the Conservative Party conference, since Theresa May's announcement that Article 50 is likely to be triggered in the spring of next year, the debate perhaps has taken on the next leg. It is the hard versus soft question that is being talked about. Clearly, I think like everyone else in this room, really, we cannot tell at this stage. We need to know more. However, I think there's a lot of evidence to suggest that, a pretty severe outcome is already priced in to the relative price of UK mid-caps versus the rest of the market, and we'll come on to back that up with some evidence. If we think about some of the other considerations, clearly monetary policy worldwide is very much across the developed world, at least, in a process of fairly significant a two-way pull, if you like, at this point in time, with the US having started the process of monetary policy normalisation, and I think as we look forward over the back of this year, likely to continue that post the election itself. The rest of the developed world, by contrast, clearly the UK included, is, if anything, moving in the opposite direction. So for us, in terms of how we're positioning the funds, I think the key question would be, how effective can ongoing interest rate cuts, further QE really be? Have we not reached the limit of effectiveness of that policy? And we, I think, will increasingly be looking towards another path, probably some sort of fiscal stimulus to try and inject life into economies now that that monetary policy stance has largely run its course. In terms of currencies, well, I think the path of least resistance for the dollar, given the comments around monetary policy and normalisation, is that that continues to appreciate against other currencies for the foreseeable future. Perhaps more pertinent to us is the dollar sterling rate. And clearly, you don't need me to tell you that after that apparent stabilisation post-referendum, moving from around the sort of 145, 148 down to about sort of 133 and apparently stabilising, the next leg down, when I left the office, we were about 122.80, I think, is, I think, a bit more perplexing. That feels to me as if that is less justified by fundamentals. And again, I wouldn't purport to be any sort of currency expert, but, looking at purchasing power parity, I think most commentators would suggest that sterling's looking 10 to 15% undervalued on that sort of measure. So I think something else is happening now. It feels like there's a real speculative driver to the currency market at the moment. Is this speculators trying to force the hand of government to perhaps say something more towards the soft exit end of the overall sort of EU exit process? So again, something I think I find it very difficult to make hard and fast judgments about at this point in time. I think bond yields for us, or usefulness, is very much about internal market leadership in the equities space. If the US begins to set or continues to set the tone for global equity markets, I think we can, as bond yields continue their rise in the US, expect to see perhaps some sort of rolling over of some of the bond proxies that have led the market, the equity market, for so long. And given the inverse relationship between rising interest rates and gold, maybe expect gold to continue to fall. And then finally, China, I think, is somewhere away, I think, from where we were at the beginning of the year. Clearly, you'll recall back in January the huge dislocation in Chinese equity markets. It does seem as if some sort of soft landing for Chinese growth has finally been engineered. So those are really just a few of the sort of considerations that we are thinking about at this point in time. Taking an enormous step back now, next few slides really are intended to look at the wider case for UK mid-caps. So Richard Watts has done, as a mathematician from Oxford, a lot of work on this space over time. The slide you see in front of you looks at earnings growth over time for the various parts of the index, so the FTSE 100, the FTSE 250, and the FTSE small cap. So it looks, rebasing all of those indices to zero in 1994, looks at what the cumulative growth of each part of the market would be over time, I think through to the end of the beginning of 2015. That shows two things. Firstly, that mid-caps have grown their earnings over that period at least more rapidly than the rest of the market. But by inspection, you can see that they seem to have avoided at least the volatility that the UK small cap space has experienced over that part of, that period of time. So again, I think if Richard were here, he'd be arguing, look, this is great. This is an opportunity to have your cake and eat it. You get the vigour of greater earnings growth, but you don't have that volatility that you might have to pick up in the lower reaches of the market. And as we'll come on to see, this is a great environment for stock picking too. Continuing the history lesson, what this slightly difficult to read chart is intended to show is that there is a strong long-term relationship between earnings growth on the horizontal axis and total returns on the vertical axis. So what we've done here is to look at the UK market in aggregate, so look at the FTSE All Share in the period since the start of 1997, and look at all of those members of the FTSE All Share, there's 160 of them that have been in that index from that point until now, and say, okay, let's look at the aggregate earnings growth that each constituent has achieved over time and the total return. And you'll see from the slope of the line that there, it would seem at least, there is a correlation between earnings growth and total returns over time. If we extend the argument further and look at trailing 12-month price earnings ratios and then the subsequent annualized 10-year performance, so PE ratio on the horizontal axis, subsequent 10-year performance annualized on the vertical axis, there is clearly a significant correlation between starting valuations and subsequent returns. So, the R2 there, the coefficient of correlation, very strong at 0.82. So I think the argument would be, right now, you have in the mid-cap index, an index which demonstrably has delivered faster earnings growth. There is clearly a relationship between earnings growth and total returns, and at this point in time, the mid-cap index, as we'll come on to see, is trading at a discount to the wider index. So it would seem an attractive entry point, as we'll go on to look at in further detail. So again, just to sort of flesh that argument out further, on the left-hand side of the slide there, you see the ratio of FTSE 250 valuation against the FTSE 100 over the period since 2005 through to now, so taking in the global financial crisis through to the current point. At this point in time, we've now reached relative valuation levels for the FTSE 250 that are consistent with the sell-off in the global financial crisis. And if you look on the right-hand side of that slide, what does that mean in terms of helping us perhaps to form views about where we go from here? On the right-hand side of the slide, the horizontal axis looks at the relative value of the FTSE 250 versus the FTSE 100 using the data on the left-hand side of the slide, and then looks at the performance over the subsequent 12 months. And it would suggest, if you look to the left-hand side of that horizontal axis, 0.95 would suggest, probably mid-teens outperformance by mid-caps over the following 12 months. So history, at least, I think, would suggest that this is an attractive entry point for UK mid-caps. So in terms of the economic impact on the mid-cap space itself, the left-hand side of the slide, I think, indicates that if we compare UK domestically orientated stocks versus the dollar exporters, so the capital goods companies, engineering, chemicals, there has been a very significant sell-off amongst the domestically exposed names. So they are now standing at around one standard deviation away from the norm. So again, at levels comparable with the global financial crisis. In terms of what the analysts themselves are doing to forecast in the mid-cap, in the UK domestic space, on the right-hand side of that page. So this shows aggregate earnings over time from the 2002 period through to now. If you look at the far right of that particular chart, you'll see that analysts moved very quickly to downgrade their earnings forecasts for this space, but have already started the process of revising them back up again. You'll see, the far right-hand side of the slide, maybe not particularly visible, but that line has moved back up again. So analysts hastily having to reconsider the real impact of Brexit on this space. So again, almost sort of back to sort of history lessons, if you like, and in terms of the way that we as a team feel that we have exploited the opportunities in this space. What the bar chart here shows is that over the life of the Old Mutual mid-cap fund, there is only 1 year in 12 when, from a stock selection perspective, the team has failed to add value. That was in 2009, when the fund was very defensively positioned and market conditions changed extremely rapidly as governments, central banks intervened to reflate the global economic system. It was very difficult in that environment to immediately reposition the fund to capture the benefit of that change. But over time, given the array of stock picking opportunities in the mid-cap space, the team, we feel, again, if we look at the stock selection component of our overall attribution, the team has a very strong record of adding value in this particular space. And I think at this point it's worth mentioning that if we look at the composition of the UK mid-cap market, contrary perhaps to general perceptions, about 50% of the UK mid-cap market is internationally orientated in the first place. So just to give you a little bit of comparison, the FTSE 100 is about 20% domestic, 80% international. FTSE 250, 50-50. The numerous small caps, in my particular world, is about sort of 60-40 domestic, international. So the UK FTSE 250 is not the UK economy. It is already somewhat more international than people give it credit for. And then if we look at the domestically orientated part of the FTSE 250 as well, I think we could argue very strongly that of that sort of 50%, probably only about a third is overtly cyclical in nature. A lot of it is, I would argue, quite structurally driven. So businesses, as we'll come on to see, like Just Eat, perhaps things like Domino's Pizza, Rightmove, businesses that actually have factors that are very intrinsic to their own business model that enable them to grow in a way which is not particularly related to the wider economic environment. I think that's another way of saying that while the market seems to have thrown its hands up in horror at the mid-cap space and has sold it off aggressively, as we've seen from the relative price charts there earlier in the presentation, actually there's only a sort of minority of that index, I think, that is directly in the firing line of whatever scale of slowdown that we see in the UK economy actually is. So it's only really, I think, the cyclical bit that we really need to worry about. The rest of it, I think, offers some very exciting ongoing opportunities. So again, continuing the theme of how we feel it's possible to add value in the mid-cap space, this slide looks at the dispersion of returns over time in the FTSE 250 environment. So what it does is, for each given year, it looks at the top 30 and the bottom 30 performers within the index. What that shows, again with the exception of 2009 where the returns were far more polarised, is that generally speaking, the better performers have outperformed, I think, by about sort of 50-odd%, the top 30. The worst performers on average underperform by around 40%. So there is a very significant spread to exploit. And again, just go back to the earlier slide, we feel that, the stock selection performance of the team over time suggests that, we have exploited that particular opportunity well. So, with all that in mind, what are we doing right now and why? Again, taking a step back, if we look at the pre-Brexit environment and the post-Brexit environment, we don't think in many ways that they've actually changed enormously in terms of the themes that we want to pursue. Why? Well, because even pre-Brexit, we still would have thought of the world as a low-growth, low-return place. That, I think, still feels the case post. In that environment, we feel and have felt for some time that there are two key themes that are going to work. So on the left-hand side of that slide, cash return stocks. So stocks with high free cash flow yields, stocks where you've got the high and rising dividend and or the opportunity for special dividends as well. Whatever the case, that cash is coming back to you, the shareholder, I say, either in the form of a high and rising dividend or it's going to get reinvested in value-enhancing M&A. But those themes, I think, are as pertinent as current now, post-Brexit, as they were pre. The other key theme that we've been pursuing is this idea of structural growth. I touched on it a few moments ago, but by this, I mean trying to find stocks, trying to find companies that have some dynamic that is disruptive, be that some sort of novel service, some sort of new product, or the ability to sell into a specific niche market, such that companies can deliver sustained above average earnings growth over a 3 to 5 year period in a way which is not particularly related to the wider economic environment. So again, I could talk at length about a whole host of these, but maybe just to pick out 2 or 3 examples just to try and flesh out what we mean by that. If we think first about the structural growth side of things, Just Eat was a business that we bought at IPO back in May of 2014. I don't know whether you're familiar with it. If you're not, this is an online ordering or food ordering portal. So delivery restaurants, typically small family-owned restaurants, will come onto the platform. Consumers, clearly will use that across the country, not just the UK, but this is something that's moved international as well. And you get this positive flywheel effect, whereby more consumers coming onto the platform begets more restaurants actually using it as well. Restaurants paying a commission to Just Eat, around sort of 12 to 14% of the overall order value, thereby giving themselves increased order flow. It is a business model which we think continues to perform very well. It's growing its orders, or growing orders in the UK at around 40% still. And we see that as, again, a relatively new concept with significant headroom for growth. And critically, there really can be only one winner in each geography. Its key competitor in the UK is only around 1/10 of the size in terms of the order value, in terms of the order volume rather, that it secures. So, we think this is a very strong example of a structural growth business that can continue to grow in a way which is not particularly related to the wider economic environment. The more so because actually over time it's used its strength in the UK to develop number one positions across a range of other geographies as well, and geographies which we think can be material: Spain, Italy, France, Canada, Mexico, Brazil. So, I think an exciting growth business which is not particularly sort of hit, we think, by any issues that may undo the UK economy over time. If we think about cash return, again, perhaps one of the themes that comes out here is this lack of correlation with the UK economy as well. So Micro Focus, I think, would be a very strong example of that. This is a software business that has eschewed the classic model of software. So software is perceived, and most management teams drive at trying to deliver top-line growth. This management team is different because they said, actually, software has become so mature. It's now been with us, in some cases, 40, 45 years. You are out of the growth phase. You're into the maturity phase of a lot of these products. If you recognise that, then the next opportunity is to manage them in a way which is consistent with their maturity. So again, rather than going for growth, they are reducing sales and marketing budgets, spending only enough on R&D to sustain those particular products, with the customer bases that they have, and really looking at them as cash cows, and using the cash generated from that activity to buy other businesses as well. So you've got the combination of modest levels of growth, which is not particularly related to the wider economic environment, but the ability just to keep consolidating that market. And then finally, we're again, keen to focus on businesses like Card Factory, like Big Yellow, the self-storage business, that have elements of both the structural growth side, but have strong cash flow too. So I think in conclusion, hopefully I've left you with a flavour of the mid-cap space being one where over time you've been able to access faster growth than has been available elsewhere in the UK market, with companies that are very dynamic. But at the same time, this is a very broad universe. The ability to add value through stock picking is very much there. And in contrast, I think, to general perception, it is not bounded by the UK economy. There's a big international and indeed a big structural growth element to the space too. So I think that completes what I had to say formally. Richard, I'm delighted to take any questions if there are any.
And we've got microphones. I'm sorry, I ignored those earlier. So it'd be great. If you have a question, we'll get the mic to you so everybody in the room can hear the question. Anybody got a question for Dan? Come on. Come on. One question. One question. I'll ask a question. Are mid-caps going to outperform large caps?
What's your timescale?
You tell me.
I mean, I think for as long as sterling in particular remains under the pressure it's currently under, and again, you'll all have your own views around the room as to what exactly is going on. This feels less of a fundamental move in the currency. There's nothing in the data to me that suggests that this level of sterling is warranted. This is about, I think, an increasing sort of speculative body of opinion against sterling. For as long as that dynamic continues, I think it's difficult to see why mid-caps outperform. So short term, could there be more pain? Yes, I think, on any sort of longer term view, 1-3 years, I think this is a good entry point for mid-caps based on the data that we saw earlier.
Okay, thank you. Any questions? No? Oh, yes. We've got a gentleman at the front and then a lady at the front. Well, can you wait for the mic, please, because then people can hear. Thank you. We'll do ladies first. Come on. So it's on.
I don't know how it works.
It's on. It'll be on.
Anyway, sorry. Excuse me. Actually, I've got two questions, but they're related. The first is, if our economic data is not that bad, our GDP is higher than many other countries, even including that of Germany, why is the pound falling? And before you answer that, when do you think, I know it's only a guess, no one's going to hold you to it, but when do you think the pound will recover?
I think the answer to both of those questions is less a question of time and more a question of clarity. And unfortunately, you're at the sort of confluence of politics and economics here. My personal perception is that the issue is that, the rhetoric at least has been around hard Brexit. So the idea that the government is focusing primarily on controlling borders and regaining control from a legal perspective of what we do in the UK at the expense of access to the single market. And business and markets are worried about that. So I think one of two things has to happen. Either the government makes a more convincing case for why life outside the single market and or the currency union is a good thing, or they begin to backpedal and say, well, actually, the ultimate deal is more akin to what we had before. And again, you are very much in the realm of politics, not economics, but I think it's how long they take to do one of those things that will determine where sterling goes from here.
Okay, thanks. Very quickly, a quick-fire question, quick-fire response, and then we must kick on, sir.
That was substantially what I was going to ask about. I think, presumably, we're looking at the trajectory of sterling as being a way of trying to guide the hand of the government in terms of its negotiations with Europe. You mentioned, I think, 60-40. My other part of my question was going to be, what proportion of that is trade-related with Europe compared to other parts of the world? I mean, quite clearly, in the United States, we must look like something of a bargain at the moment.
Yeah, I mean, I think very roughly, these are rough numbers, but if you look at the overseas orientated part of the mid-cap world, I think that divides roughly a third, US, Europe, and rest of the world in terms of the trade exposure. So, the European element of itself is not necessarily going to make or break the fortunes of those companies. But I think, sorry, I know you said quick fire. In terms of the currency side of things, not that I was at school at the time, but it feels a bit like the UK being forced out of the ERM, i.e. markets trying to make governments change what they're doing. That's what I think is going on.
Superb. Ladies and gentlemen, Dan Nickols, thank you very much.